Too many people look at a house they'd like to buy and ask themselves, can I afford it? Not a smart way to go about it when buying your first house, experts tell us.
Well, the first step I think they should take is to go ahead and take a first-time homebuyers class. And that will give them a lot of information as far as the basics that they'll need to further their purchasing.
You'll find out in those classes that it's better to crunch the numbers and see how much house you can afford before you go out looking for a home. You can try to do it yourself, but it's better if you work with a lender. It's a process often referred to as pre-approval, in which a bank or lending institution lets you know how much they will lend you to buy a house.
They should gather all their pertinent information. What I mean by that is that they should find their last 2 to 3 years tax returns, which is what the bank is basically going to request, and they should also bring in their 3 months bank statements, which is going to let the bank know how much they actually have in the bank or their savings. And they should also bring their copies of their last paycheck stubs. It allows them to see what their current expenses are, and they could do this at home on their own and basically just gather all their bills and really see where they're at. And what I mean by bills, they should really consider all their credit cards, they should consider their car payments, and really see how much they're spending, because what the bank is going to do is they're going to do the same thing, and the more expenses you have, obviously the less money they're going to let you borrow.
And there are other costs that may not come up until the day you want to move in, such as how you're going to pay for the move itself. And will you be able to resist the urge to buy new appliances or furniture to put into that new house?
What I ask people to do is just try to consider taking as much furniture with you as you can. Yeah, you want to make your house look nice, but what you want to do more importantly is to be able to keep your house, because you don't want to lose your house as soon as you get there. Are out-of-pocket expenses, because there's going to be a lot of people that are going to provide services to you, and those services need to get paid. And that's where the closing costs come in.
And don't forget about property tax you'll be paying each year. The government certainly won't.
Now, when you purchase a property, and let's say the property's $100,000, well, 1.5% is going to be $1,000. You know, so the bank, what it does is it takes the total for the year. Okay, that's your total tax for the year, and then it divides it by 12. So whatever you get, that's going to be your monthly payment added to what you owe the bank.
Unless you're buying a new house, it's a good idea to plan for sudden or inevitable repairs.
And one of the things they need to consider really is the fact that how long do I believe this roof is going to last?
And unless you're paying for your house in cash, you can add to your new monthly expenses homeowners insurance.
What people should know about homeowners insurance is that it's required by all banks. The reason why it's required is because the bank is securing their interest in the property. Very simply is, if the house burns down, the bank is not going to have anything to come back on. You may not have the money to replace it.
And keep in mind this simple rule when figuring out how much you can afford to pay for a home.
The 36% rule is the ratio that the bank calculates that you can afford to pay them back, meaning how much income is left over at the end of the month for you. So in other words, if you take $1,000 and you take 36%, obviously that's going to leave you $360. That's how much the bank perceives that you will have available for your expenses, for your mortgage expenses, you should say, and still be able to pay the rest of your expenses on a monthly basis without having any problems.
Lenders may allow a higher ratio if you put more money down, have a history of saving money, or can prove that you're likely to be bringing in more money.
There's a lot of places where you can go for help to find out how much you can afford. And one of the places that you can obviously go is to nonprofits. That's one. They'll provide assistance in most cases, but not in all cases, free. Okay? Now, if you don't want to go to a nonprofit, that's fine. You can always go to a bank. A bank will also do a pre-qualification, let you know how much you qualify for, and they'll give you all the assistance. Obviously, they're going to want the business. And the third option would be to go to, let's say, websites. You can go through websites. You can go to HUD.gov and they have a lot of information on what you can and can't afford, where you can find programs that allow you to have the most affordability.
Once you know how much house you can really afford, it makes the process of looking for a new home much easier for you and everyone else involved in the process.